Welcome to the Wealth Setting Podcast. This is episode 502. Today is December 8th, 2025. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. Hey, today I got a quick episode for you. I've gotten a lot of questions based on what I've said in previous episodes about the changing complexion of the Federal Reserve. Bottom line, I think the new Federal Reserve coming in 2026 is going to be very Trump-friendly. I'll explain that and get to all that in a second. Stick with me in this episode because I'm going to end it with a different take on the Federal Reserve than you're hearing in most places. The other big question that I want to answer is, people are asking, should they buy ahead of this week's FOMC meeting? Listen, the odds that the Fed will cut rates is 80%. So I think it's really baked into the market at this point, and the only thing that would really shift things dramatically is if they don't cut. And I think that's highly unlikely too, because I don't think the Fed wants to create, unwanted market chaos going into the end of the year. So yes, I do think it's likely they cut 25 basis points. It's not really going to matter a hill of beans, but the market will probably pump that up, and it probably will ignite the typical end-of-year Santa Claus rally. We'll have to find out. Bottom line, should you or should you not be buying this week? Listen, you saw me buy over the previous couple weeks when the market was down. I still think it's a healthy market. I am putting new money into the market at this point, and I'm effectively 100% invested. Now, some of that, but not all of it, has to do with I do think we're going to have an accommodating Federal Reserve going into 2026 and beyond. And there's an old adage on Wall Street about don't fight the Fed. Now, that usually means if the Fed is cutting, you want to buy into the market because liquidity is high and stock market prices are likely to go up. And on the other hand, if the Fed is raising interest rates, that means that they're pulling back on liquidity and the market is likely to go lower. In this case, the Fed is easing for a number of reasons. That they're cutting. I don't think they're going to cut dramatically. You've heard me say multiple times before that I think it's extremely unlikely we're ever going to go back to the extreme low interest rates that we saw during the pandemic. And people that are sitting on these 3% or less 30-year mortgages, well, that's just not happening anytime soon, I don't think, unless there's a major catastrophe. I think the Federal Reserve is just trying to get to neutral, and they're trying to figure out where that neutral interest rate is, given we're in a post-pandemic as well as post-peace dividend new economy with, the Cold War and all the turbulences going on across the globe. There's definitely a new reality of where that inflation target rate should be. And I don't think the Federal Reserve fully knows yet, and that's why we're going to see these different arguments and discussions among the central bankers. But there's no doubt that the U.S. Federal Reserve is easing. They've cut back on their quantitative tightening, which means as of this month, they're no longer repurchasing any of the bonds that mature on their balance sheet. The Federal Reserve's balance sheet has come down substantially since they started quantitative tightening back in, 2022 or something, but it's still an astounding, something like $6.5 trillion. That means each month, since they're no longer doing quantitative tightening, they're going to be repurchasing somewhere around probably $50 to $100 billion each month that are maturing. So they're not allowing the balance sheet to get lower every month. By doing that, that keeps a lot of money in the system. That in itself is a form of loosening. So regardless of what they're doing with 25 basis point cuts, that 50 to 100 billion injection into the economy every month is substantial. And when you hear things about, China's going to get rid of all their U.S. treasuries. Well, China, over the last probably 7 years, has substantially reduced the number of treasuries that they hold, as have a few other of the central banks. But bottom line on that, too, is that China only holds about $700 billion or so in U.S. treasuries. And when I say only, think about it. If the Federal Reserve is continuing to buy somewhere between 50 and 100 billion a month, then in at least 8 months' time, or somewhere around there, within a year's time, the Federal Reserve is maintaining at least as much treasuries on their balance sheet as the country of China owns. And I'm digressing too much down that path. So this week, as to whether the Federal Reserve cuts rates or doesn't cut rates, or regardless of what projections they make for the future, I think you take all that with a grain of salt, because going into 2026, the composition of the Federal Reserve is drastically changing. It's nothing nefarious. It's not that they're not going to have their traditional, political independence. But going forward, it is very likely that the Federal Reserve is going to be Trump-friendly. And it's just because of a series of events, and more than anything, it's because Trump had a gap in his presidency. The Federal Reserve is set up with varying degrees of staggered appointments. For example, the governors of the Federal Reserve Board are appointed for 14-year terms, with every 2 years someone's term expiring. The reason they have that really long 14-year term is so that no one president can appoint everybody at one time. Think about that. 14 years is a long time. But with Trump having a gap of 4 years in there for his election cycle, that means that once we get into next year, if my math is correct, and my understanding of the current composition of the Board of Governors, is that there will only be 3 Biden or 3 Democrat-appointed Federal Reserve governors once we get into 2026. That's 3 out of 7. For most of the things that the Board of Governors votes on, they only need a simple majority. Since the other 4 governors have all been appointed by Trump, or will be appointed by Trump as he puts more on going into next year, as other terms expire, that will be more favorable and friendly to Trump. Now again, I don't think the Federal Reserve is losing its independence. It's just the way the system works, and the timing is different this time around than in the past. It also doesn't mean that Trump's going to get his way on everything, because one of those appointees that I'm talking about is the current chairman, Jay Powell. Everybody forgets, and they talk about the big battle between Trump and Jerome Powell and all the mean things that Trump says about Powell. Well, bottom line is Trump appointed Powell. And overall, regardless of what Trump says about him, I think Jay Powell has done an extraordinary job over his term. He's had a lot of challenges coming out of the pandemic, the 40-year inflation like we hadn't seen before. He handled that quite well. His term expires in, I think, May as far as the chairman, but he can still stay on as a governor. We'll have to see if he does or doesn't. I personally hope he does, because again, I think he's done a pretty good job. And while he may not rubber stamp everything that Trump wants, that isn't necessarily a bad thing. And I would still check the box on him as being Trump friendly, because he's definitely not in opposition to Trump. And when I talk about Trump, I mean growing the overall economy, not the fact that they agree or disagree on where rates should be. But when I talk about a Trump-friendly Federal Reserve, I mean one that's not purposely going to go against economic growth, especially from a spiteful standpoint. And as far as the other 3 governors that have been Democrat appointed, well, they're traditionally known as doves, meaning that they do like lower interest rates, that they haven't traditionally voted for, tightening money, lower inflationary policies. And while that could change, again, just to spite Trump for political reasons, overall, they're fairly easy money people. So I think you're going to see the Fed move in the direction of an easier money policy, at least for the next couple years. I've only been talking about the 7 members that are governors, but that's the other side that is going to become very Trump-friendly, because when you look at the 12 regional district presidents, every one of them's terms comes up and expires at the end of February. Now, they're not appointed by Trump or the Senate or anybody in the federal government, but they are approved by the Board of Governors. And remember, the Board of Governors generally only needs a simple majority vote, meaning they need 4 people to have a majority. And there are 4 friendly Trump people potentially as governors going into next year. And so as these 12 districts locally pick their presidents and they submit them to the Board of Governors to be approved, they're going to know that if they have any really wild cards or anybody that's extreme to a position that Trump's going to be opposed to, I think the fact that they'll get approved would be highly unlikely. And so again, it isn't that the 12 regional presidents are all going to rubber stamp everything that Trump says, or that they're all going to be Republican appointees or anything like that. I'm not saying that, but I'm saying that compared to previous time frames, I think the composition of the new incoming 12 regional bank presidents will at least be Trump neutral. And so with somewhat neutral 12 regional bank presidents and 4 of the 7 governors Republican appointed, again, you end up going into 2026 and beyond with at least a neutral, if not a Trump-friendly Federal Reserve. I think that means pro-growth, and when you combine an accommodating Federal Reserve with the deregulation policies that Trump has put into effect this year, I think all that pays dividends and sets up some potential good economic growth next year. Now, that doesn't guarantee the stock market's going to go to the moon, but I think we are set up for pro-growth policies next year, which could mean that we could see the stock market do what it hasn't done in probably 30 years, which is have 4 consistent back-to-back double-digit growth years. Hey, I can't predict the future. Keep your fingers crossed on that. But here's a different take on the Federal Reserve and central banks in general. And keep this in mind. Number one, you hear recently that Trump is undermining the independence of the Federal Reserve and yada, yada, yada. Listen, I think it's all nonsense. I think that's just all negative Trumpism. And I'm not sticking up for the guy. I'm just saying, look, there's real politique. People are people. People have political affiliations. Nobody is totally independent. If you want to tell me that the Fed has been independent in the past, I don't think we have to go back any farther than Janet Yellen. And if you want to tell me that Janet Yellen was politically independent when she was chair of the Federal Reserve, I'm going to call BS on you. And for all the countries outside the U.S. that are so worried about central bank independence, again, we could point out as many countries as you want, but we don't have to look any farther than our neighbors to the north, where their current prime minister was not only the former head of the Bank of Canada, he was also the head of the Bank of England. Now, how's that for central bank independence, right? It doesn't exist. But that doesn't mean that these are all corrupt systems or they're all taken over by the political machine. It's just the way the system works, and it works quite well. Again, you'll hear all kinds of stories about the creature from Jekyll Island and gold standard this and, end the Fed that. And hey, I like Ron Paul as much as anyone. But you know what? Here's my experience over more than 40 years of building my own wealth. You need to stop complaining about the Federal Reserve. You hear people complain all the time. It's never their fault, right? It's the Federal Reserve's fault. It's their boss's fault. It's their ex-wife's fault. It's their parents' fault. Blah, blah, blah. You know whose fault it is? It's your fault. If you don't have the wealth and the economic stature that you want, it isn't the Fed's fault. It's yours. I tell you this out of experience. I started building my wealth when I stopped complaining and started creating. When I started figuring out ways to take my God-given talents to create products and services, to earn a higher income, and then to take that income and to invest it into appreciating assets. So listen, unsuccessful people can sit around and blame the Federal Reserve all they want for their economic problems. The bottom line is, since the Federal Reserve was created back in, 1913, how many millionaires and billionaires have there been? There's been plenty. So if you want to be a millionaire or a billionaire, stop whining about the Federal Reserve and go out and start making money and invest it wisely. That's all for today. Until next time, this is John Pugliano wishing you the very best returns.